Financial responsibility, owning your money story. Learn how to take ownership of your financial situation. Imagine waking up one day with complete confidence about your money, not because you are rich, but because you know exactly where you stand and where you are headed. Financial responsibility is not about earning millions, having perfect investments, or never making mistakes. It's about taking ownership of your financial story instead of letting circumstances, other people, or bad habits control it. Many people blame the economy, their salary, inflation, or their past. While these challenges are real, they don't have to define your future. Every financial success story begins with one decision, accepting responsibility for your money. In today's video, we'll explore 10 powerful lessons that can completely transform the way you think about money. These are not complicated financial theories, they are practical principles that anyone, whether you are a student, employee, entrepreneur, retiree, or parent, can apply. Let's begin your journey toward becoming the author of your own financial story. Point number one, accept that your financial story is yours to write. The first and most important step toward financial responsibility is accepting that your financial life belongs to you. Many people spend years blaming their parents for not teaching them about money, their employer for paying too little, the government for taxes, or the economy for inflation. While these factors certainly influence financial outcomes, they should never become permanent excuses. Taking responsibility does not mean blaming yourself for every hardship. Instead, it means recognizing that from today forward, your decisions matter more than your circumstances. Your financial future is shaped by the habits you practice consistently, not by the events that happened years ago. Every paycheck you receive, every purchase you make, every loan you accept, and every investment you considered becomes another chapter in your money story. The exciting part is that no matter how your story began, you always have the opportunity to write a better ending. Successful people are not necessarily those who had the easiest start. They are often the ones who decided to take control despite difficult beginnings. Ownership creates confidence because it shifts your focus from problems you can't control to actions you can take today. Instead of asking why is this happening to me, ask what can I do next. That single mindset shift changes everything. Financial responsibility begins with honesty. Look at your current financial situation without fear or denial. Whether you are ahead, behind, or somewhere in the middle, the truth becomes your starting point. Remember, you cannot improve what you refuse to acknowledge. Once you accept ownership, every decision becomes an opportunity to improve your future rather than repeat your past. Let's say example, two friends both graduate with student loans. One spends your years blaming the education system and avoids budgeting. Other accept that debt, creates a repayment plan, increases skills and pays off the loan years earlier. Their starting points were identical, but ownership changed the outcome. Next point number two, know exactly where your money goes. Financial responsibility requires awareness. Surprisingly, many people work harder every month but have no clear idea what their money actually goes. Small daily expenses often disappear unnoticed until the end of the month. When the bank balance seems much lower than expected, financial awareness means tracking income, expenses, savings, and debt honestly. Every dollar, euro, pound, or rupee has a destination. If you don't tell your money where to go, it will quietly disappear. Tracking spending is not about restricting your freedom, it's about understanding your habits. Often, the problem is not low income but unconscious spending. Subscription services, food delivery, impulse shopping, convenience purchase, and emotional spending can slowly consume significant portions of income. By recording expenses for just 1 month, many people discover patterns they never realized existed. Awareness creates opportunities for improvement. Once you identify unnecessary expenses, you can redirect that money toward goals that genuinely improve your future, such as emergency savings, investments, education, or debt repayment. Financial responsibility means making intentional decisions instead of automatic ones. Budgeting does not mean saying no to everything you enjoy. Instead, it means choosing what matters most. Every expense should reflect your values and priorities rather than temporary emotions. The more awareness you develop, the easier financial decisions become because you understand the long term impact of each choice. Let's say example, someone discovers they spend $100 every month on multiple streaming subscriptions they barely use. Canceling unnecessary services allows them to invest that money monthly, creating long term wealth instead of short term entertainment. Next point number three, separate needs from wants. One of the greatest financial skills is learning the difference between what you truly need and what you simply want. Needs are essential for survival and daily living: food, housing, healthcare, transportation, and basic utilities. Wants are everything that improves comfort, convenience, or enjoyment, but is not absolutely necessary. Modern advertising constantly encourages people to confuse wants with needs. Every new smartphone, fashion trend, or luxury product is marketed as something essential. Financial responsibility means resisting this pressure and making thoughtful decisions instead of emotional ones. Delaying gratification is one of the strongest predictors of long term financial success. Buying something immediately may feel satisfying today, but saving and investing that money may provide much greater benefits in the future. This does not mean eliminating enjoyment from life. Instead, it means ensuring your wants don't prevent you from meeting your financial goals. Responsible spending allows room for both enjoyment and security. Before making any purchase, ask yourself whether it solves an important problem, supports your goals, or simply satisfies a temporary desire. Giving yourself time before major purchases often reduces impulse spending because emotions settle and logic returns. Financial discipline grows stronger every time you choose long term value over short term excitement. Let's say example, instead of upgrading to the newest smartphone every year, someone keeps the perfectly working phone for 3 years and uses the savings to build an emergency fund that later helps during unexpected medical expenses. Point number 4: build an emergency fund before emergencies happen. Unexpected events are not rare, they are part of life. Jobless, medical emergencies, home repairs, business challenges, or family responsibilities can appear without warning. Financial responsibility means preparing before problems arrive. An emergency fund acts as your financial safety net, reducing stress when life becomes unpredictable. Without emergency savings, people often rely on credit cards or expensive loans, creating even bigger financial problems. Saving consistently, even in small amounts, builds confidence because you are prepared for unexpected situations. Many people believe they need a large income to save, but consistency matters more than size. Small weekly or monthly contributions gradually grow into meaningful protection. Emergency funds should remain easily accessible but separate from everyday spending accounts. The purpose is not investment growth but financial stability. Having savings changes your decision making because you are no longer forced into desperate choices during difficult times. You gain the freedom to think clearly instead of reacting emotionally. Financial responsibility means expecting uncertainty instead of assuming everything will always go according to plan. Preparation transforms emergencies from financial disasters into manageable challenges. Let's say example for this: when a family's refrigerator suddenly stops working, they use money from their emergency fund to replace it immediately instead of using high interest credit cards. Next point number 5: manage debt wisely instead of letting debt manage you. Debt, it- Debt itself is not always the enemy. The real challenge is using debt responsibly. Some debt, such as education or business investments, may increase future earning potential when managed carefully. However, high interest consumer debt often limits financial freedom by consuming future income. Financial responsibility means borrowing intentionally rather than emotionally. Before taking any loan, understand the interest rate, repayment period, total repayment amount, and how monthly payments fit into your budget. Never borrow simply because credit is available. Responsible borrowers think about tomorrow before spending today. Paying more than the minimum payment whenever possible reduces interest cost significantly over time. Avoid using debt to maintain appearances or finance lifestyles beyond your means. Financial peace comes from living within your income rather than constantly chasing higher spending. If debt already exists, don't ignore it. Create a repayment strategy and stay consistent. Every payment represents progresses toward greater financial independence. Managing debt responsibly strengthens discipline, improves credit worthiness, and creates more opportunities for future investments. Example: one person finances luxury vacations with credit cards for several years, another saves first and travels later. Years later, one is paying interest while other enjoying financial freedom. Next point number 6: invest in yourself before expecting bigger income. Your greatest financial asset is not your savings account or investment portfolio. It's your ability to earn. Financial responsibility includes continuously improving your knowledge, skills, health, communication, and professional abilities. Higher income often follows increased value. Reading books, taking courses, learning technology, improving leadership, or mastering communication can significantly increase career opportunities. Personal development creates returns that often exceed traditional financial investment because knowledge stays with you throughout life. Successful people understand that education does not end after school. The world changes constantly, and lifelong learning helps you stay relevant. Investing in yourself also includes maintaining physical and mental well being because productivity depends on health. Confidence grows when you know your skills continue improving. Financial responsibility means viewing learning as an investment rather than an expenses. Every new skill expands your opportunities and strengthens your ability to adapt to future changes. Let's say example, an office employee spends evenings learning data analysis online. Within a year, they qualify for a higher paying position because they invested in skills before waiting for a promotion. Next point number 7. Save and invest consistently for your future. Saving protects your present while investing builds your future. Financial responsibility requires both. Savings provide security for short term needs, while investments help money grow over time through compounding. Waiting for the perfect moment to invest often means missing valuable years of growth. Starting early, even with small amounts, is more important than investing large amounts later. Consistency beats perfection. Long term investing requires patience because markets naturally rise and fall. Responsible investors focus on decades rather than daily price movements. Diversification reduces risk by spreading investments across different assets instead of depending on a single opportunity. Financial responsibility means understanding that wealth usually grows gradually rather than overnight. Avoid chasing unrealistic promises of quick riches. Instead, follow disciplined investing based on long term goals. Time is one of the most powerful financial tools available, and responsible investors learn to use it wisely. Let's say example, two people both plan to invest. One waits 10 years for the perfect time. The other starts immediately with the small monthly contributions. Decades later, the consistent investor builds significantly greater wealth through compounding. Next point number 8. Protect your financial future through smart planning. Financial responsibility is not only about earning and investing. It's also about protecting what you will build. Insurance, legal planning, retirement preparation, and beneficiary planning all play important role. Many people focus entirely on wealth creation while ignoring risk management. One unexpected event can erase years of financial progress without proper protection. Insurance is not unnecessary expense. It's a strategy for reducing financial uncertainty. Retirement planning should begin much earlier than most people expect because time significantly influences investment growth. Planning also includes writing financial goals, reviewing progress regularly, and adjusting strategies as life changes. Responsible people prepare not only for success but also for unexpected setbacks. Financial planning provides direction because every decision supports a larger purpose. The goal is not predicting the future perfectly, but being prepared for different possibilities. Example for this point, a young family purchases health insurance before experiencing serious medical issues. When unexpected surgery becomes necessary, insurance prevents financial hardship. Next point number 9, teach and practice healthy money habits every day. Financial success is built through habits rather than occasional big decisions. Daily choices shape long-term results. Responsible financial habits include budgeting regularly, saving automatically, avoiding impulse purchases, reviewing financial goals, paying bills on time, and continuously learning about personal finance. These habits may seem small individually, but together they create lasting financial stability. Consistency matters more than intensity. Missing one day does not matter. Giving up entirely does. Teaching these habits to children, family members, or friends also strengthens your own understanding. Financial responsibility spreads through positive influence. Healthy habits gradually become automatic, making responsible decisions easier over time. Success is not about being perfect every day, it's about returning to good habits whenever setbacks occur. Your financial future depends far more on repeated actions than isolated moments of motivation. Example for this point, someone automatically transfers 10% of every paycheck into savings before spending anything else. Over several years, this simple habit builds substantial financial security without requiring constant effort. Next point number 10, create a legacy through responsible financial choices. Financial responsibility extends beyond your own lifetime. Every responsible decision you make today can positively influence your family, community, and future generations. Building wealth is not only about personal comfort, it's also about creating opportunities for others. Financial literacy, generosity, ethical earning, responsible investing, and thoughtful planning all contribute to a meaningful legacy. Legacy is not measured only by money, it include the values, habits, and knowledge you pass on. Children often learn financial behavior by observing adults rather than listening to advice. Demonstrating responsibility teaches lessons that last for decades. A strong financial legacy includes honesty, discipline, generosity, and a resilience. Wealth without wisdom often disappears quickly, while wisdom continues creating value across generations. The greatest financial gift you can leave on others is the knowledge of how to manage money responsibly. Every chapter you write today influences someone else's story tomorrow. Example: parents regularly involve their children in simple budgeting discussions and saving goals. As adults, those children develop strong financial habits and avoid many common money mistakes. Finally, financial responsibility is not about perfection, it's about progress. Your financial story does not have to be defined by yesterday's mistakes, today's challenges, or tomorrow's uncertainty. It is shaped by the decisions you make starting now. Remember these 10 principles: accept ownership, understand your spending, separate needs from wants, build an emergency fund, manage debt wisely, invest in yourself, save and invest consistently, protect your future, develop healthy habits, and create a lasting legacy. Every successful financial journey begins with one responsible decision and then other. If this video helped you see money differently, share it with someone who needs to hear this message. Subscribe for more practical financial education that empowers you to make smarter decisions, build lasting wealth, and take complete ownership of your financial future. Your money story is still being written. Make the next chapter your best one. Thank you.